Okay, this video, let's continue talking a little bit about financial instruments and the markets themselves. In this case, let's talk a little bit about how the companies are divided up, if you will, or how do we recognize, who are owners, etc. So in this case, we're just looking at two different types of securities. In this case, there's two kinds of common stock. There's Class B and Class A shareholders. And this happens a lot in companies. Um, Sometimes to distinguish between founders, sometimes distinguish between newer versus older shares. But in this case, let's say that, as far as the capital, it has been equally contributed by both the Class B and the Class A shareholders. Now, Class A shareholders typically have more rights. And as you see here, Class A shareholders have all the control. Well, if they have all the control, that means they're going to have a greater um, amount of risk associated with their investment than the Class B shareholders. And of course, if they have more risk, they should also be getting more returns. So again, capital shows how the money was gathered, Class A and Class B. Again, the difference between the two really has to do more about rights. But in this case, both classes share risk, but A has more risk than B. Both classes get returns, but Class A gets more because Class A has more risk. And of course, in this case, Class A also has all of the control. Another way we can look at this aspect of investing in capital, etc., is looking at shareholders versus creditors. So again, in this case, we have a company that's 50% shareholders and 50% creditors or debt holders. But what that means is that who has control of the company? Well, the shareholders have control the majority of the control of the assets themselves, right? So in this case, they both have risk. Shareholders have more risk than creditors, mostly because of uncertainty, and the debt holders have fixed income, so it's a little bit more certain for them. Because they have more risk, they're also going to have more returns, and that also means that obviously, as we know, shareholders actually control more of the company than the debt holders would hold. So again, we can show how the control and risk and returns and the actual investment percentages, all of these contribute to the characteristics of the securities and, of course, the risk and return of those securities. So equity securities, stock is the one that we're most familiar with. Stock itself represents ownership or equity. Now, preferred stock receive dividends before common shareholders, but they're fixed. They're a higher position in the case of liquidation, but also they don't have any control. So, preferred stock is what we sometimes refer to as a hybrid security. It has the word stock in, it gets paid dividends, but it doesn't typically vote. So, the dividends are although they're not guaranteed, they're certainly fixed. So they're more certain than common shareholders. So it has aspects of debt, aspects of stock or common stock. And as we know, common stock has control. So common stock, think about the shares of Microsoft. They grant some voting rights and they have the potential for dividends. And preferred stock is different, typically doesn't have voting rights. A company like Coca-Cola might have both common stock and preferred stock. Again, we will talk about these in more detail as we get to some later videos. But let's look at some basic characteristics, right? We look at these securities and three characteristics: control, return, and risk. If you're a common stockholder, an equity security, typically you have control. You vote for the board, and that board is answerable to the shareholders to some degree. What about returns? You have the right to earnings as dividends or value of reinvestment in the company. And as far as risk, earnings can fluctuate. So there's some uncertainty with dividends and value. In addition, should things go south, you are also paid last. You're last in line with respect to getting paid in bankruptcy. And there are certainly other rights, but let's concentrate on these three as we look at these securities. What about fixed income securities? These are securities that have fixed income cash flows. Primarily, we're talking about bonds. The payments from these securities are fixed, while the price can change as interest rate risks and other types of market information change. They reflect a loan of essence from an investor to the company. And again, where equity represents a purchase of ownership. So companies like AT&T issue bonds to raise capital, which they again to repay with interest at fixed intervals. They have bond ratings. We'll talk about that here in a couple of meetings that reflect the risk of default. Higher rated bonds are safer, but generally offer lower returns because higher rating means less risk. Less risk means lower returns. But if we come back and look at our basic characteristics, control of fixed income, right? There's no control of the day-to-day operation, and only, and this doesn't even happen all the time, they could take control of the company if it's in financial distress. As far as the returns on fixed income securities, you only get what you're promised. And as you know, if you borrow money from a bank, the only thing you promise to do is pay back the interest and pay back the principal. So again, most of the time, the return you get is fixed. You know exactly what it is. Now, with respect to risk, even though the risk in general is less, there are sort of more kinds of risk. There's default risk, the chance that the company will go bankrupt or might not make payments. There's interest rate risk, inflation risk. There's risk that the bond will actually be paid off early or retired earlier. So there are all different kinds of risks associated with investing in these fixed income securities. We had mentioned default risk there. This is the chance that the company would miss some payments in interest or principal. We have a couple of companies. In this case, they talk about Moody's, S&P's, and Fitch. These companies analyze our companies and provide an analysis of the risks. And again, in this case, they're looking at the chance of default. So companies at the top, the highest rating here, AAA rated, they refer to these as prime ratings or highest quality ratings. As you go down this list, we get to obviously different gradings, if you will. And these gradings, as the letters change, going down the table here, we're getting to higher and higher chances or greater chances of default. In fact, at the bottom, the C range down here, these are extremely speculative. And even down at the bottom, we actually have bonds that are already in default. So again, these companies do this for us. It's a great service that they provide. Obviously, they get paid for it, but they help us to understand the underlying risk of not getting paid back when we are lending money to companies. If you think about the returns on bonds, we typically refer to that as yield. The current yield is the annual interest payment divided by the current price of the bond. So if you bought a bond today, in the next year, you would get paid a certain coupon because it's a loan, right? You divide that, that is your return the very first year you own the bond. The yield to maturity is the estimated annual rate of return, assuming that you hold it to maturity. So it includes the current yield, the return you get on the income piece, plus the actual return on the capital gains piece. So the yield curve is a picture of maturity at different lengths of time. So a yield curve is an interesting picture. When we get to talk about bonds in later videos, we'll talk about how this yield curve is ultimately used in the valuation of debt itself. But here's a picture of the yield curves. The red yield curve here represents the yield in June of 2020. And you can see that the highest rate down here for 30 years was 1.48. And one month was, it looks like, well, it's almost zero. And the blue line represents the yield the very next year, 1 year later. What you can see is that short-term yields got lower. They decreased. In fact, they're almost zero. In some instances, if you think about the real return of these, including inflation, actually has a negative real yield. But when we get to longer time frames, 30-year bonds, these ultimately you can see are a little bit higher. In fact, not quite double, but pretty close to being double what the yields were the year before. So this picture, how this slope works, the relationship between this year and last year, all of those factors are things that we'll look at to try to understand how the value of bonds changes over time. There are some other definitions or topics that will, terminology, if you will. An indenture is the terms of a debt agreement, right? It's essentially the contract or a promissory note. So this is going to tell us about any of the rules besides you have to pay the interest, had to pay the principal. There are also some other information about what companies can and cannot do decision-wise. There is a trustee, they're an agent, that they act in the interest of bondholder. They enforce the rules that are listed in the indenture. Now, how do we recognize owners of bonds? Well, there's two ways. A registered bond means that bond has your name attached to that. So imagine that the company has a book, and that book lists all the people who own bonds. Your name is in that book. That's how you're identified to get your interest paid to you. Bearer bonds, on the other hand, your name is not specifically attached to a piece of paper or to that bond. So there's the only way you have evidence of ownership is you actually have possession of the piece of paper. So there's no real registration. Your name is not in a list somewhere. So you have to identify the company, and when it's time for the interest, you have to claim your interest, if you will, from the company by typically your broker would do that for you to make sure you got your interest. If you think about debt, there's really short-term, long-term. The short-term securities are ones that trade in liquid markets. Remember, we used that term liquidity earlier. These are low-risk investments with very low returns. The primary player in this are treasury bills. They're issued by the United States government. But there's repurchase agreements. These are a sale of the security that's going to be repurchased at a set date. Sometimes these are attached to international trade. We have negotiable CDs or jumbo CDs. I think we're all kind of familiar with what a CD is. These are slightly different than those that you and I as individuals would buy, but they are issued by banks and they're in very large units. Then there's commercial paper. These are issued by corporations. Again, they could be very short-term kinds of loans. but they're unsecured. So basically, it's a signature type of a loan. Sometimes companies, it's the end of the month, it's time for payroll. The company is a little bit shy in having enough money to pay for their payroll, but they've got some checks coming in, the 5th of the month. So they say, hey, I'm going to go out, I'm just going to borrow money for 3 days so that I can pay my payroll, and then I'll unwind this loan in the next 3-4 days. That's commercial paper. Very short term. Now, these things by definition are also very low risk, right? So companies pay these. They don't typically default on their things like their commercial paper. Another type of security is something called a derivative. A derivative is an instrument whose value is linked to the value of something else, right? So if an example is an investor wants to be able to buy or sell an asset in the future at a predetermined prices. So oil companies often use futures to lock in prices and protect themselves from volatility in oil markets. Options, on the hand, give you the right, but not the obligation, to buy or sell an asset. So investors use options for speculation or to hedge against some potential losses they may have in other types of securities. We had mentioned futures contract, and it's a binding agreement to buy or sell a security or commodity in the future. Speculators buy and sell futures to make money on changes in the prices of the contract. So there are certainly speculators in the marketplace. However, on most of the futures and options that we look at, most of that activity happens with investors who want to hedge some type of risk that they're taking. So again, if you think about farmers or miners or somebody in manufacturing that uses a lot of petroleum for their oil, they want to guard against changes in costs of those products so they can utilize these contracts to help smooth out some of the riskiness there. Options, though, are more often involved with companies and other kinds of securities. Again, these are the right to buy or sell at a specific price. You don't own the stock, for instance. You only own the right or the option to purchase or sell the stock. So sometimes, if you have risky investments, an option can be used to help offset, again, the changes in prices. Now, they mention here that they're a little risky. That is because typically 100% if the option expires, you lose the premium that you pay for these. Now, I mean, that makes it sound like they're very risky instruments, and quite frankly, what this statement is true. When we get to the last part of our videos for this particular course, we'll talk about these derivative securities and find out that maybe the risk is not as great as they make it sound here. Finally, the last kinds of instruments we might be interested in are foreign exchange instruments. Again, these are contracts. They could be futures or options that help us with our trade agreements, right? With our currencies that we trade. So this is what sometimes you may hear people talk about, the Forex exchange. Foreign exchange instruments are talking about trading currencies. So when companies like McDonald's operates in multiple countries, they have to deal with different securities. So foreign exchange contracts help them manage the risk associated with fluctuating exchange rates. So again, anyone involved in international trade is going to be concerned about this kind of risk. So now, as we go on to the future videos, we're going to start talking about how we analyze these securities and those types of instruments as we go along. So again, thanks for listening to the video. I will see you soon. Bye-bye.